Okay, so today we're going to chapter 1 in managerial accounting. Chapter 1 basically is an introduction to the course. So from this chapter 1, our learning objectives including 3 parts. The first one including understand the basics of managerial accounting. We have described the management cycle and the need for managerial accounting information. We're gonna also talk about differentiate between financial accounting and managerial accounting. Number 2, we need to understand the role of globalization and the lean business model. The lean business model is the most important one that we need to understand. And then we describe the impact of globalization on business. We explain the lean business model and its corresponding management practices. Number 3, we need to understand the importance of professional responsibility. So we talk about the importance of ethical responsibility, corporate governance, code of conduct. We understand the code of conduct or code of ethics for the professional accountants. Now, the first part describes the management cycle and the need for managerial accounting information. We can see that this form or the cycle has shown in our textbook. It shows the flow of management activities. Managers carry out 3 main activities: planning, implementation, and control. Okay, so we need to, after we finish reading the book, we are supposed to try identify the situations where managers might carry out for each of these activities. So first of all, planning. Important part of planning is to identify alternatives and then to select from among those alternatives that we figure out the one best fit the job, right? And best fit the job and to further benefit our organization. Once the alternative has been identified, the planning of management are often expressed formally in budget. Budget are usually prepared under the direction of the controller. The controller is basically the manager in charge of the accounting department, like CFO. Typically, budgets are prepared annually and represent management's plans in specific quantitative terms. Now that is planning. Now it goes to implementation. Implementation, in addition to planning for the future, managers must oversee the day-to-day activities to keep the organization function smoothly managerial accounting data. For example, the daily sales reports or monthly sales reports, those are often used in this type of day-to-day decision making. It's better to allocating resources, directing, and motivating people. So that is under implementation. In carry out control, managers seek to ensure that the plan is being followed. So one of the most important tools will be used under control is the feedback. Feedback is whether operations are on track is the key to effectively control. Performance report are being used because performance report has been used to compare the budget to the actual result. It suggests that where operations are not proceeding as planned and where some parts of the organization may require additional attention. So that is a performance report under control. So the work of the management are summarized in this whole pictures, right? We found a very big one: vision, mission, objective, strategies, and then it goes to the management analysis and information. So better understand this chart, we have a detailed analysis in our textbook. Strategy, planning, implementation, control. Okay, so let's go to the most important parts. For the first part in our chapter 1 is to differentiate between financial and managerial accounting. And read this in our textbook, page number 6. There are 7 key differences that can be identified between the financial and managerial accounting. So for the manager, financial accounting reports are prepared for external parties, whereas managerial accounting reports are prepared for internal uses. You have taken the financial accounting. You will see that you prepare all those financial statements. It goes to the public. It goes to external parties. But management accounting is different. We service for the internal parties. We emphasize for the users, we emphasize on the future. Financial accounting summarizes past transaction. Managerial accounting has a strong future orientation, so for forecasting. Relevance of and flexibility of data. There we go. Financial accounting data are expected to be objective and verifiable. Managerial accountants focus on providing relevant data, even if the data are not completely objective or verifiable, because we need the data to make decisions, right? So we're not, it doesn't have to be objective. But when you go to financial accounting, when you prepare the financial statements, you have to make sure that there's no variable. Okay, so there's no bias. It's always been objective. Emphasize on timeline. Financial accounting focus on precision when reporting to external parties. Managerial accounting help the decision makers by providing a good estimate as soon as possible. So you could be estimated, but it has to be a time frame. So it has to be as soon as possible in order to make the decisions. Now, focus on the segment of management of an organization. So financial accounting is concerned with reporting for the company as a whole. Managerial accounting focus more on the segments of the company. So the examples of the segments including production lines, sales territories, divisions, department, etc. Now, the last but not least, there are two more left. We have regulation. Financial accounting, we have just learned we have to follow IFRS or ESPE, but managerial accounting is not bounded by any standard. So different companies might have a different rules or different types to do their financial information as managerial accounting for internal use purpose. Managerial accounting is not mandatory. So financial accounting is mandatory because various outside parties require periodical financial statements. Managerial accounting is not mandatory. Although the discussion of the differences between financial and managerial accounting might suggest that they are independent, right? Because one is for the internal service, one is for external services. But it's not true because as the information from managerial accounting reports often fits into financial accounting report. So the similar financial information has been used. So they're totally connected together, not totally independent. We have to understand that part. Now, for the next two, we wanted to talk about the reasons for increased relevance and importance of managerial accounting. The impact of globalization. Over the past 3 decades, there has been a significant increase in worldwide competition in many industries. Organization that is successful in its local market might face competition from other organizations in other parts of the globe. So on the other hand, globalization offers organizations the potential for greater possibilities, such as increased network with similar organizations and new business partners or access to the new market. So that is the reason, the impact of globalization on the business. Now, the lean business model. Due to competition from around the world, companies have adopted different improvement programs to ensure that they produce better products or deliver better services. These improvement programs we call lean business model. Okay, so the main idea underlying this model is to eliminate waste. Customers or clients are no longer accept the cost of waste are passed on to them in the price they pay or in the time they wait for products and services to be delivered. So that is why the lean business model showing up. Companies choose to adopt and implement one or more management practices that focus on different aspects of the lean business model. So we're going to talk about these practices: just in time, total quality management, process reengineering, theory of constraints. So first we talk about just-in-time. Managers are at Toyota pioneered the just-in-time approach. So using this approach, companies purchase materials and produce goods only as needed to meet actual customer needs. In an ideal setting, the company would carry zero inventories. Although few companies have been able to reach the zero inventory level, many have been able to reduce their inventory level dramatically. So this is the just-in-time model. We can see from our picture, our slides right there. Receive customer orders and then schedule production. So it depends on how much the orders is being. So we schedule the production. We receive materials just in time for production. We complete part just in time for sampling. We complete the products just in time and then ship to the customer. In this kind of procedures, we eliminate our inventory level. Okay. So the benefits of the just-in-time system will reduce inventory cost. We have higher quality products, greater customer satisfaction, or less warehouse space needed. The next practice we're talking about is the total quality management. The two main characteristics of the total quality management approach are A, focus on serving customer, and systematic problem solving using team of frontline workers. Various tools are used by this team to solve their problems. A good example is the benchmark. Benchmark involves studying organizations that are the best at performing a specific task with a view of learning from them. So when you, by any chance, when you go for your accounting designation in the future, you will use benchmarking for comparing. So it depends on the business you are in, right? You're going to choose the benchmarking company and do the comparison. Another important tools are used by the team is the Plan, Do, Check, Act, which is the picture showed up, the Plan, Do, Check, Act cycle. The cycle applies a specific method to problem solving. Now we can see that we start with plan. We study the current process, collect data, analyze the data, and develop a plan. Now we go to do, implement the plan on a small scale, if possible, and then collect data. And then go check, evaluate the data connected during the do phase. And we want to see, did the expected improvement occur? If the result is successful, we make the changes. So we go act. So this is the whole plan. Okay. Now, the next one, we're going to talk about process re-engineering. This approach diagrams a business process in detail, question it, and completely redesign it to eliminate unnecessary steps and reduce opportunity for errors and reduce costs. It is a radical approach that is used to remove waste from business process. So we could see that from step one, a business process is diagrammed. And then we go, each step in the business process must be justified. The process is redesigned to include only those steps that make our product more valuable. So we actually go through each step of the business process and figure out which one we need to focus on. We only leave the useful one. So this approach focuses on simplification and elimination of waste efforts. Its integral idea is the elimination of all non-value added activities. We only keep the valued activities. So this is the process re-engineering approach. The next one is the theory of constraints. This theory focuses on effectively managing any obstacles that might prevent organizations from achieving their objectives. It focuses on the managing of constraints as the key to success. Now, so when you get a chance to read your book, you could open your book to a flowchart of a aluminum tennis racket production line. So that is a full example to totally get to explain this theory of constraint. Okay, you could follow the examples to produce a personal TOC just for practices. So this is the TOC theory. We say identify the constraint with limited string on process to the capacity of the constraint, and then focus on strengthening the weakest link. TOC focuses improvement efforts on objective achievement barriers. The next part, we talk about importance of ethical responsibility and corporate governance. Due to globalizations, business from different parts of the world tend to interact with one another. As companies interact more with other organizations from across the world, the conduct of these organizations have become a very important issue all over the world. So we talk about professional ethics, various scandals and allegations involving the unethical behavior managers and top business executives receive considerable attention from the media. And often unethical behavior is motivated by focusing on achieving short-term result at any cost. These actions are usually based on one or more of the following reasons. The organization expects unethical behavior. Everyone else is unethical. Behavior unethically is the only way to get ahead. So to counter some of the reasoning held on ethical behavior, companies have implemented formal ethical code of conduct. That's why we need code of conduct in every company to do the business. Okay. Now the last is corporate governance. Corporate governance, the system by which an organization is directed and controlled is corporate governance. Effective corporate governance enhances stakeholders' confidence that the organization is being managed with their interest in mind. That is basically is our chapter 1. So this is not much calculation. It's just for basic introduction for managerial accounting. The managerial accounting provides information to manager to make better informed decision to help the company fulfill its mission and achieve its objectives. Business have incorporated lean business practice to respond to the increased competition due to globalization. Organizations have implemented formal ethical code of conduct to promote all employees to behave in an ethical manner. So that is our summary for chapter 1. Any questions?
No.